In Chapter 14, we'll be discussing partnership taxation. So, typically, a partnership is formed when two or more folks get together to start a business. A couple of the terms we'll be discussing in this chapter are inside and outside basis. Outside basis is the basis of the partnership in the hands of the partner, and then inside basis is that partner's share of the basis of the individual assets that belong to the partnership. Usually the amounts are the same, but they could be different. For example, if the partner contributes property with a fair market value greater than the basis in the hands of the partner, that may trigger a difference between the inside and outside basis. The beginning basis in the partnership is usually the basis of the contributed assets. So this idea of basis in, basis out means that the partnership is, in a sense, stepping into the shoes of the contributing partner. If a partner contributes services to gain a partnership interest, then that is ordinary income to that partner, and they have to report that to the extent of the fair market value of the partnership interest. Also, any assumed liabilities by the partnership or any release of liability by a contributing partner, that's treated as a distribution, and that would reduce basis because the partnership is taking some of the debt liability away from the partner, relieving the partner of that liability. That would reduce the basis. So, ordinary income or loss, we've talked about this concept before in other chapters, and it's generated by the sales revenue less ordinary, usual, and necessary expenses. There are also items that are passed down on K1, we'll talk about that later, that are separately stated items, such as charitable contributions that may be reported on Schedule A for a partner who may itemize deductions. And we talked about guaranteed payments before as well. These are payments made to partners that are calculated without regard to the partnership income. As far as depreciation is concerned, we follow in partnerships the same rules that we do with sole proprietorships. However, Section 179 expenses are sent down separately or as a separately stated item on Form K1 to the partner. Excuse me. Also, as partners, they cannot exclude any health care premiums that are paid by the partnership on their behalf. And these are treated as guaranteed payments, which are taxable to the partner. How do we know an item should be separately stated on K1 when it's sent down from the partnership to the individual partner? If it can, whatever the item is, can be handled differently by different partners, then the item should be separately stated. For example, I mentioned charitable contributions before. So one partner may benefit from the charitable contribution because that partner itemizes. Another partner may not itemize and may take the standard deduction and therefore would not benefit from that charitable contribution. The most commonly stated items, rental income, interest and dividend income, capital gains and losses, and Section 179 expenses, as we said, are separately stated items. K1 is this report I keep referring to, and it is where the partnership reports the partner's share, proportional share, of any income and separately stated items to the partner. And yes, for a partnership, the partnership files an information return to the IRS called Form 1065. The partnerships themselves are not taxed, but the income generated by the partnership is taxed at the partner level on Form 1040. And since a partner is not an employee of the partnership, then the income generated from that partnership and passed down on K1 to the partner is considered self-employment income and is therefore reported on Schedule E. How do we calculate this self-employment income? Well, the partner would start with their share of the ordinary income, add any guaranteed payments that they received, and then deduct any business income, these gains and losses from selling business assets included in ordinary income, and also deduct any Section 179 expenses on K1. I mentioned earlier the outside basis. This is listed in the text, of course, as well. This is calculated for each partner, and it begins with the basis of property or funds contributed, and then we would add any fair market value of services rendered, because they have to, that contributing partner must pay taxes on those services that are rendered. Therefore, that increases the basis. Any additional cash basis of property contributions after formation would increase the basis. They have more at risk, more skin in the game, if you will. Share of partnership ordinary income, because they're the partners being taxed on that, they get to increase their basis. And again, we generally want to increase our basis in the partnership so that in the event we ever sell our partnership interest, we'll have less capital gains to pay taxes on. Any share of liabilities that are assumed by the partner on behalf of the partnership increases the at-risk amount and increases the basis to the partner. Any cash or property that's distributed but not below zero, you can't have negative basis in a partnership, would reduce the partnership's interest, as would any share of the partnership loss, because the partnership would get the tax benefit of that loss on 1040, and so the partner doesn't get the same benefit twice. They would reduce the basis of their partnership interest. Reduce also, the basis would be reduced by the share of separately stated loss and expense items, again because there's usually a tax benefit for those things to the partner on their tax return. And then if the partner is relieved of any liabilities by the partnership, then that would reduce their at-risk amount, and that would reduce their outside basis. So the general rule, a partner recognizes no gain or loss on a liquidating distribution, but there is gain to be recognized when like money or marketable securities are distributed in excess of their basis, and so that is income. This pre-contribution gain, it's a topic that you should probably review in the text as well, but the pre-contribution gain says that in the event, as I mentioned earlier, a partner contributes property where the fair market value is greater than the basis of the property, then there could be that gain that was deferred could be recognized. Specifically, it's within 7 years. So if, for example, a partner contributes equipment to the partnership, and then within 7 years that equipment is distributed to another partner, then if this occurs within 7 years of the original contribution, then the contributing partner will have to pay taxes on that deferred gain, where that is to say the amount of fair market value over the basis at the time of contribution. And any distributed property received by the partner usually means that that partner assumes the basis as the same basis that was held in the partnership. So in this case, the partner steps into the shoes of the partnership and maintains the same basis, and usually holding period as well. So what happens then when a partnership is liquidated? So a distribution of money in excess of basis, as we said, that causes a capital gain. A loss can be recognized when the amount received in liquidation is less than the outside basis. That is to say, they are paid an amount less than their basis, but this loss can only be recognized when the amount paid is in the form of money, receivables, or inventory. If a partner sells a partnership interest, it's treated as the sale of any capital asset. If the partnership has any considerably increased or appreciated inventory or accounts receivable, it's possible that some of the capital gain could be ordinary. And of course, a partner who sells their partnership interest would report this sale like any capital asset on Schedule D of Form 1040. If you have any questions on these or any of the concepts in Chapter 14, please let me know.